All right, so this is episode 1 of the Chermane Trades Mentorship. What we're covering in this first lecture is high resistance versus low resistance market conditions. All right, so the whole theme of this mentorship is to get straight to the point. Okay, we're not going to waste any time. Let's go. Characteristics of a high resistance liquidity run, okay, known as HRLR, okay, high resistance liquidity run market condition. For starters, candles overlapping or bunching together, okay, whenever you have lots of ranging and consolidation, okay, that is typically known as a high resistance market condition. All right, when price action is slow and lethargic, you're often met with deep and uncomfortable retracements in price. Whenever you see fair value gaps not staying open or simply not forming at all, okay, those are all signatures of a high resistance market condition. All right, these are market conditions that we want to avoid. Every day is not a trading day. I repeat, I don't care what anybody else says. I don't care what any other mentor says, any other trader says, whether they're profitable, unprofitable. Every day is not a trading day. We only look to engage in the market when the odds are drastically in our favor. On the other side, characteristics of a low resistance liquidity run, okay, abbreviated by LRLR. Little or no consolidation. Okay, the candles are more spaced out and not ranging. You'll experience fast movement. Okay, prices in a hurry to reach its objectives. Fair value gaps are completely staying open or being left partially unfilled. Okay, a lot of times in my trading and my market reviews and just my entire channel as a whole, you'll see me talking about breakaway gaps, and I want to see this fair value gap stay open, or I want to see the lower half or the upper half of this fair value gap stay open. Things of that sort. Okay, that's because I'm only looking to engage in a low resistance market condition, and that's one of the signatures that you can look for in price. Okay, these are market conditions that we want to engage in. Trading in low resistance market conditions makes day trading fun, less stressful, and easy. Okay, looking back on the days when you went on tilt or possibly took numerous losses, okay, look back on the days you had easy trades that went straight to your targets. Okay, chances are your best trading days occurred during low resistance market conditions and your worst trading days occurred during high resistance market conditions. All right, so that's something that I want you to do personally. Okay, and it may sting a little bit to reflect back on times you went on tilt or blew your account or put yourself in deep drawdown or whatever the case may be. Okay, those instances, what market conditions were you trading in? Chances are, let's go back a slide. Chances are you're trading a price action that had one, if not all of these characteristics. On the flip side of that, I want you to look at the trades that were just real easy, that one trade every now and then where you just get in and it just runs to your targets, just flows. It was bread and butter, very little drawdown. It panned out perfectly. Couldn't ask for it to be any better. Chances are those trades happen in market conditions with these categories, okay? Low resistance signatures. Examples of a high resistance market, all right? Just want you to take a look at the screenshot. I don't have any annotations or anything of that sort. I just want you to look at what we're seeing here, okay? Notice what we covered in the high resistance slide, okay? We do not have fair value gap staying open. Okay, there's a lot of overlapping candles in here, okay, a lot of wicks. Price is just not in a hurry to get anywhere. We get displacement here, we're right back into the range. Right, not a lot of fair value gaps forming in here. It's just real sloppy, real muddy, not really that clean. Okay, this is the day where it's real easy to get tripped up, real easy to blow your account, lose your combine, your funded account, your live account, whatever the case may be. Okay, this is just real difficult, real high resistance. Now, some traders will look at this screenshot and say, oh, I can see about 3 or 4 setups in here. Sure, absolutely. As long as the markets are open, there's going to be something to do. There's going to be a trade. Somebody's in here pressing buttons. Somebody's in here taking 10, 12 trades, 4 or 5 trades. There's always something to do if the candlesticks are printing. That's the flare or the snare. Sorry, that's the trap. That's what gets people tripped up. They think, all right, market's open. I got money in my account. I got a fresh combine. I'm going to go in here and do something. Nope. It's the wrong approach. At least not when you're starting out. Okay, so high resistance here. Another example. Now you may look at this and say, it went lower. Yes, but I want you to really study the delivery and how it's going lower. Okay, say we're looking for an objective down here. You believe price is likely to reach for a level down in a discount. Look at the delivery. Okay, a lot of back and forth, a lot of wicks. I want you to imagine yourself in this trade. How comfortable are you? Okay, retracements, 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 a lot of overlapping candles. Okay, this is the bunching that we're talking about. Fair value gaps are not forming here. It's not showing that it's in a hurry to get to your targets. Can you trade this? Absolutely. But when you're first starting out and you're seeking profitability, it is in your best interest to avoid trading days like this. All right. I promise you, longer term is better for not only your equity curve, but your mental capital as well. Okay. You have to protect your mental and your overall stress when you're engaging these markets. So is it going lower? Yes. But the manner in which it's going lower is very just lethargic. It's real stubborn. It's just, it's taking a sweet time. And if you're in this, or if you're trying to engage, you're going to get knocked out at break even a few times. You may take a couple losses before finally getting that one win. It's just not worth the time, not worth the stress, not worth the mental equity. Okay. Now, examples of a low resistance market. Look at that. Isn't that refreshing? Isn't that just, it's a breath of fresh air. Just compare here, here. I have a few fair value gaps here, okay? Not much on the chart, but I want you to notice what we covered. Let's go back a few more slides. Characteristics of a low resistance liquidity run market. Little to no consolidation. Okay, the candles are spaced out. We're not ranging. We have fast movement. Prices in a hurry to reach its objectives. Fair value gaps completely staying open or left partially unfilled. Do we see that here? Yes. Is price showing a willingness to go lower? Is it showing a speed? Is it showing that's in a hurry to go lower? Absolutely. Fair value gaps. Are they being left open or partially? Yep. Look at this one here, left open. This one here, the majority of that fair value gap left open. This one here. Okay, we respect midpoint of it. Wicks trading above to the high of the fair value gap, no big deal. We're staying in the lower half of that. Fair value gap here, portion of that being left open. Fair value gap here, portion of that being left open. And we're gravitating lower fast. Okay, it's showing a willingness. It wants to get down here. That's what we want to see. That is low resistance. This is way less stressful. This is fun to trade. This is when you get those no drawdown entries. This right here is what makes trading fun. This is what we got in the industry for. Not this. Okay. Another example of a low resistance market condition. Same thing. Fair value gaps being left open, partially, majority left open. Yep. Beautiful, no drawdown entry. We're not talking about entries or anything in this first lecture, but visually you can see the logic there. Fair value gap here. Majority of that being left open. That's low resistance. We don't have any consolidation. We get reasonable retracements that don't last long. They're short-lived, break lower. Reasonable retracement, short-lived, breaks lower. And you can see it's in a hurry. It's in a hurry. It's in a hurry. It's moving towards an anticipated target down here. This is what we want to engage in. This is low resistance. This is where you make your money right here. This is where you make your money. This is where you blow accounts. This is where you go on tilt. This is where things get ugly. Same thing here. This is where you go on tilt. This is when you pay for combine resets. This is when it gets bad. All right. Protect yourself, protect your equity, protect your mental by avoiding that one simple mistake of trying to push too hard and engage in markets like this or this and simply wait for market conditions like this here or this here. Okay. Now, little side-by-side comparison. I just want you to look at this and ask yourself, which market is more fun to trade? And be honest. Okay, don't be stubborn and pick the right. Obviously, okay, based on what we just covered, the left side here is more fun to trade. Okay. Low resistance market here. High resistance market here. Homework assignment. What I want you to do is go into your charts and find 2 examples of a high resistance market and 2 examples of a low resistance market. Okay, I need 4 examples total. Find these examples in the time windows that you like to trade. So if you like trading Asia, all right, find 4 examples for Asia. If you like trading the PM session, I need you to find 4 examples within the PM session. Okay, go into TradingView, use the replay feature, go back as far as you need. It doesn't have to be in the market of your choice that you can't find examples. Go into S&P, go into NASDAQ, go into Dow. Okay, it works on every instrument, every pair. Okay, it doesn't matter. I also want you to annotate your chart with text describing what makes that market condition high resistance or low resistance. See my example in the next slide, and I'll show you that in a minute. Before I do, remember, as long as the markets are open, there will always be something to do. All right. However, this does not mean you should engage. Every day is not a trading day. I'll say it again. Every day is not a trading day. Just because the markets are open, just because candlesticks are printing and price is fluctuating, that does not mean you need to be in there pressing buttons. Okay? We want to engage when the market conditions are so in our favor, where it's just bread and butter, easy, clockwork. That's what we're traders. That's what we're here to do. Okay? That is the definition of a trader. We take advantage of opportunities that are just so tilted in our favor, it's too good to pass up. And we avoid the days and the market conditions that are likely to hurt us. That is what a trader does. All right, and here's a quick example of the homework assignment. This is what you should be going in your charts. So here's an example of a low resistance liquidity run, and I have the text here. This is an example of a low resistance liquidity run because fair value gaps are being left partially unfilled and price is showing an urgency to reach its objective. It's not ranging or going sideways. Instead, it's moving fast and fluid. Okay, that is the definition of a low resistance market. So I need 2 examples of these and 2 examples of a high resistance market condition. And that is it for our first lecture video, the mentorship. We'll probably have around 10 to 12 lecture videos, depending on the pace and what I want to include in each one. Hopefully you found this insightful. Again, this entire mentorship is just going to be to the point. Everything that I wish I would have had in a mentorship, as far as simplicity, as far as detailed and explanation, I'm doing my best to provide that to you guys here. So love y'all. I'll see you all in the next lecture video shortly. In the meantime, do the homework. Do not skip. Okay, do the homework. That is where the real work comes in. Okay, you can't just watch the videos and then turn it off and just wait for the next one. Okay, do the homework assignment. I'll go back to it so you can have it on the screen. Do the homework assignment, go into your own charts, because this is probably one of the most important videos, lecture videos in this mentorship. We can talk about bias and setups and trading models and risk management and all that stuff, but if you can't even identify which market is likely to hurt you, all that stuff goes out the window. Okay, it doesn't matter how good of a trader you are. It doesn't matter how disciplined you are. It doesn't matter what strategy you use, ICT concepts, retail, trend lines, Elliott wave, indicator. It doesn't matter. If you can't understand what a high resistance market looks like compared to a low resistance market, you're going to hurt yourself. All right, so make sure you do the homework assignment, and I will see you all in lecture 2. And in that lecture, we'll go over some order flow signatures and how to tell when you're on side. Okay, love y'all. See you soon. Peace.